Welcome, friends. In today's class session for the paper Advanced Financial Management live virtual classes, I see Ashish Gupta welcomes you all. Now, student, in the previous class, we have started our discussion on the topic of risk management, and in this today's class, we shall continue our discussion on the same topic. And however, please note that uh, when we were doing our topic, so our discussion on the value at risk has been left. Okay, so in today's class, we shall cover the in detail the topic of value at risk, and after that, we shall also solve some numericals as well as some MCQ shall also be taken. So, and even one case scenario shall also be taken. And student, one more important announcement that I want to make from 1st August onwards, the AFM classes, now these are held on Monday, Wednesday, and Friday morning. Now, now on the Friday, the AFM class will not be there. I think there will be some other class are scheduled on that days. So now onwards, from 1st August, AFM classes will be held in the morning on the Monday and Wednesday only. Okay, student. So this has development some has taken place. So I want to let you know about the same. So I thought I just make you aware about the same. Now, student, now let us start. I think we have assignment with you, and we start solving the assignment question. So before we discuss the assignment question, let me discuss with you the concept of value at risk. Just hold on some time. Just I'm joining the same. Okay, student, now let us go back to our discussion for the value at risk. Now, in the previous class, we have discussed the various types of risk. Okay, and we have also discussed the concept of uh, we have also concept the discuss of the strategic how we basically uh, we cover in the last class we have also seen that how the standard deviation takes we use to measure the profit risk of any portfolio. So we were discussing about the standard deviation in the last class. Now continuing our discussion on this standard deviation in the last class from the last class. Today we shall there is another measure for the uh, risk, that is value at risk, that we shall discuss today. Now when we talk about student the value at risk, just we I read the line then I will let you know. A measure of the risk and investment which can be in a portfolio capital investment or a foreign exchange etc in the normal markets condition in a particular period. It is an estimate how an investment might lose in a day. Okay. Now, what is exactly where? Okay. Now, let us start our discussion on what is value where. Okay. See, students, it was somewhere around 1990s. I think it was somewhere around JP Morgan or 1990s. It has been, of course, the concept has been coined somewhere in 1930s, but more properly it has been used in somewhere around in 1990s when I think JP Morgan a bank has started using the same. Now, exactly what is this value at risk? It means if we go by the definition, it says how much maximum loss you will have, or there is what are the probability. Even it is also considered as a probability. I will show you how we can use the same like in the form of a probability. So it says we go by the definition again, I am just going to the definition. A measure of the risk and investment which can be a portfolio. Okay, it can be capital investment or it can be foreign exchange. So generally these are used by the three, and especially in case of bank, it is very important because there are many type of a portfolio and even the investments are there, etc. In the normal market condition, this is a very important condition, that market condition should be normal. In a particular period, it estimates how much investment might lose in a day. So it let us know what is the estimate, or we can say how much there are possibility level that we will lose certain amount. Okay, generally this amount, how much investment might lose means estimate. Generally, it is considered from the base of confidence level. So when we talk about the features of the where, okay, now let us start features of the where. First of all, where basically, or I can say that just before I go for the features, we can say that it is kind of a somewhat to an exposure. It is very important. It is an exposure to the loss in normal market conditions. Okay, because generally it is concerned with the adverse move. Okay, of course profit is there, but sometimes there may be loss, and it consider how much loss is expected to be lost. Okay, so now when we talk about, let us go back to our components. Now, what are the components of the calculation? How we calculate it? Basically, there are three components. The one is time period. Okay, it is generally in the definition, it has been considered on a day base. Of course, that can be customized. Okay, that can be customized as per our requirement that we will see in the further questions. Okay, then confidence level. Okay, generally 95% and 99%. See, it is the estimation. It is generally relating to the estimation. That is a confidence level. With the 95% confidence, I can say that my loss will not be more than it. It is just like a statement like this. Okay, and then there is a loss in percentage or amount is okay. It can be defined in terms of percentage as well as an amount. Okay, if percentage is with me, if I multiply the amount of this percentage with my investment or the portfolio, then the amount comes. Okay, it is simply a calculation. So it is a method that I can say that whether it is a percentage or it can be amount. Then very important, it is based on a standard deviation. It is statistical tool and which is used based on the standard deviation. So it is very important that it is it use the standard deviation, and we will discuss some question, then you will know. Of course, the standard deviation is widely used. And it is a time horizon. As I linked you here, we have said that it is a loss in a day. It can be applied to different time horizons, say 1 day, 1 week, 1 month, and so on. So it depends on our horizon. Okay, because everyone has their in mind their own horizon. Like I want to know the loss for the 1 day or 2 day. So this is the loss on horizon. Okay, now next is the probability. It is very important, the property. Assuming that the values are normally distributed, probabilities of the maximum loss can be predicted to the normal market condition that I have mentioned here. That has been mentioned here, that is normal market condition. That is normal market condition. So it is generally assumed that the market is the probability values are normally distributed, and that's why we use the normal curve in our calculation. I think you recall that this normal curve you must have studied at your 12th class level in the mathematics. So this is the normal curve normally referred used in our where calculation, and this is the basis. And it is very important to note that only this is a, because it is that's we can apply this bear model. This is a basic assumption. Risk control. Now from this where we can set our limits for maximum loss. Generally, it is also there is one numerical on the same, where we can came to know that more than this loss I cannot bear. Okay, so they can say, okay, of course, I put my risk limit somewhere else, somewhere at somewhere point I put risk limit. So this is very important. Now next is the jet score. It is the important that how we it if we I read the definition indicates how many standard deviation this side it is the negative values, this side positive values. Okay, so I want to know. See, when we calculate the anywhere, so what we have to do? We have to do some variance. We have to need some score. Okay, it is also called. I just give you one from in this regard. Or I do one thing. I just explain you on a separate sheet. Now, see, I just again draw the diagram. See, student, this is a value of mean value. Okay, I am just considering a portfolio. I'm just considering assuming a portfolio. Now, this portfolio is a mean return is there or mean value, something we can say that it is a mean return. Now, as I move in this direction, the value becomes start reducing. Okay, at some point of time, this value may even become the negative. Okay, now this is kind of a probability. Okay, if I say it is a probability that 5%, say my value is say 100, mean value is 100, and this value is 0. So if I say there are a 5% probability that I will have a loss. Okay, so this is computed as a normal curve. Now this can also be presented in the form that I am a 90% confidence level. With a 90% 5% confidence level, I'm sure that I will not have any loss. Okay, so 95% confidence level is equal to, we can say that other way around, it is a kind of a 5% probability. This can also be asked other way around. Okay, so when we say my loss will not be more than I will not have a loss and percent, I'm saying it is a 5% probabilities are there. So to calculate this value, I need one variable. Okay, I need some standard deviation. We can say that normal deviate. Okay, it is also called standard normal deviate or Z score. Okay, and generally what happens, this value of the generally this is also called with the confidence level. Okay, so accordingly we use some standard normal variate, and these are very easy to remember. Okay, student, you will not face any problem. These are very easy to remember. So the normal variable, I'm just saying the confidence, I'm just writing here confidence level. Okay, and here it is also called quantile or Z score. Okay, so what are these values are there? Now, if I say I want a confidence level of 90%, 95%, 99%, and 99.99%. The popularly used variables are confidence levels are 95% and 90%. These are the most commonly used Z scores, or we can say confidence levels are used. Now, what are the equivalent? These values are there: 1.82, 1.645, 2.3626, and 3 point. Sorry. I just rewriting again. I am mistakenly. The values are same. I just 2 seconds, only 1 second. I The confidence levels are 90%. I'm just writing before it. There were no error. 99%, and this is 99.9%. Okay, now quantile will be the values will be 1.282, 1.645, and 2.326 and 3.715. As I told you, normally in the most of the case, commonly used values are these two confidence levels are commonly used a maximum case. Now, here generally what happens when we use this value, we generally round it off. We use it as a minus two. This is 1.28, 1.65, 2.33, okay, 3.72. So these are generally values are used. Student, it is very important to note that generally when we talk about value at risk, so these values are normally on the this side, negative side. Okay, these are generally because we take the value from this side. It is our mean value, and here the values are start decreasing. Okay, so and when we talk about the loss, okay, value at risk. So generally it is used with a prefix of minus. Okay, of course we use without prefix of minus, no problem, because these values are remain. These are the variation. These are the quantile, or we can say jet score that can be used, but generally it is somewhere shown as in a form of prefix with the minus. Okay, so this is the logic behind this value at risk, and these are mainly used for a business in the portfolio companies are use it. Okay, and now when we talk about this, these are our features of the value at risk. Okay, now when we let us see what are their uses. Next is comes the why we use it. Okay, first of all, this can be used for to measure the maximum possible loss on any portfolio or a trading position. Okay, generally this is also used by the maximum. This is investment bankers. They use the maximum, and I will suggest the one name. I think there is one movie on is also this where concept that I think it is called margin. The movie's name is Margin Call. Okay, I think in this movie there was some investment in some investment bank that came to know from the where that the company's portfolio is carrying a very high level of risk that will wipe out their equity as well. So this movie is based on this concept of where. Okay, and then it comes the next is use a benchmark for performance measurement of any operating or trading unit. Generally, we set a trading benchmark that below this your loss should not be go, or we can also set your value at risk should not be below it. Okay, we also set the use the benchmark as a benchmark for a where as a benchmark. 1 second. Then it to fix the limit for an individual dealing in a front office of a treasury department. As I told you, there are three kind of a office. One is front office, then there is a back office, and then there is sorry, there is a then mid office, then there is a back office. Okay, generally these limits are put on the front office in the treasury, because in a treasury they have to carry out the transactions. So since they do not exceed a loss limit, the limits are placed or where limit is are placed on them on their trading, and especially in case of a bank it is very important, because after in the last class I was discussing with you the case of Baring Bank. Now in this Baring Bank, what happened, as I told you, in the front office was also control of this Mr. Nick Leeson. So ultimately they have incurred a very huge position. So after that, somewhere around 1990 and 1999, the Basel, there is a committee on banking regulations, measuring the controlling the bank risk. Basel committee has come out with the norms according to which they can put some where or risk restriction on this uh, trading positions can be taken by the front office. Now This also helps to decide the trading strategies. This also helps to decide about the trading strategy, what strategy they have to take. That is, if the limit might goes to about this, I have to liquidate my position. This kind of trading strategies can be uh, decided. Okay, it tool of asset and liability management, especially in case of bank. Generally, it is case in asset liability management because they have to measure the level of their liability and because level of assets and management. See what happens. I tell you, a bank on a liability side and asset side, they have to maintain some kind of a balance. Okay, and especially in case of a foreign exchange, when we will talk about the foreign exchange chapter, through this ALM, they came to know that our limit because since exchange rate is a volatile, sometimes there can be a mismatch or there can be a gain or a loss both on any side in an exchange position. So they have to see that we have to control this. So this is so we cannot go that in that much detail, but it is generally just to understand it. The asset liability management is also covered, can be used through this where. So student, this was all about the where. Now let us start some solving some questions of the on the where. Then we will more understood how we use the where. So meanwhile, I just check is there any query? 1 second. Okay, no queries there. So okay, student, let us move to the one questions assignment part. This assignment has been already uploaded. Now let us start with the question number 1. Now let us see how this question is there. Now question read like that. Neil holds rupees 10 crore shares of XY Limited, whose market price standard deviation is 2% per day. This is very important. We need to be kept in mind what is the time horizon. Assuming 252 trading days in a year, determine the maximum loss level over a period of one trading day and 10 trading days with a 99% confidence level. So we want some confidence level 99. Okay, student, please remember that. I will show you that with a more confidence, we have to, chances are there. Losses are chances are there. So let us see. Assuming share prices are normally for level of 99. Okay, normally distributed, we can say that. Of course, this line has been missed out. The equivalent Z score for the normal cumulative curve shall be 2.33. Even if it is not given in the question, please memorize it. It is very simple. Okay, there is nothing to worry about the same. Okay, now let us see how we compute the same. And very one important point, it is very important to note that uh, higher the accuracy or confidence level, the where will be calculation will be for the higher the loss estimate. Okay, higher the confidence level, higher will be the it is subject to again higher estimate would be loss estimate would be. Okay, again the time horizon is more, then higher will be the loss. Okay, now let us start solving the question. I missed it out. Okay, now assuming that so we have since the prices are normally okay distributed for 99% confidence level, the equivalent Z score is 2.33. Okay, so what we do, see when we draw the as I told you. Now, see, when it is in the question, it says our portfolio value is 10 crore. Okay. And our standard deviation for one day is 2%. Okay. So we can say that our value is likely to volatility in terms of rupees is 2% of okay. So this is the maximum loss. This is we can say it is a volatility. Okay, it is a standard deviation. Okay, now the maximum loss. Okay, the maximum loss for one day at 99% confidence level is rupees 20 into 2.33 46.60 lakh. So this is
Sir,
yes. Yes, yes.
okay, sir. Okay, sir.
This is a very simple answer. Okay, this is a very simple because we are multiplying. See, if we see here, I just show you by way of diagram. This will be the value here. Okay, this is my 1%. Okay, it is a 1% probability. Okay, I can say like that. There is a 1% probability. There is 1% probability that my loss will be more than 46.6 lakh. See, we can visualize it like that. I am 99% confident that for one trading day, the maximum loss for a one trading day will be not more than 46.60 lakh. Okay. So my this is a loss position. This is my loss position. Okay, so I'm just this saying that, or even I can say it otherwise. There is a 1% probability that my loss will be more than what is that. Now, see here, this value is medium value. Okay, this is the mean value. Okay, this is the mean value. Now, when we measure, we how we compute. See, we when we have to compute this value is normally computed by this as much as far off. Whenever we move in this direction, higher variable, higher z score is used, and this z score is multiplied. Higher the use is used, and this z is multiplied with the value of standard deviation. Okay, we multiply it with the standard deviation. So we can say that z is basically x minus mean value divided by standard deviation. Okay, so now in some questions we may be required to compute this z value. Okay, now if I say that say if from this even I can compute the mean value. My what is my mean return? Okay, my z score is say here 2.33 minus. Okay, x means minus my loss is say 46.60. Okay, and my mean is this. I don't know the mean. I want to compute the mean. Okay, my this is value is 20. Okay, from this I can even compute. I just show you. Okay, this become my mean value. So mean value I am considering here 0. Okay, so this side totally there is a profit, and this side it is a loss position. Okay, this is a loss position. Now here I want to estimate how much loss. Maximum loss is 99%. So it is the what is now. If I say I want to be a 95% level confident. Okay, if I change that, I want to be 95% confident. So at 95% confidence level, confidence level, my variable will be 1.65. Okay, so what I do, I multiply this value 33. So this value will be lie somewhere here, that I am 5% confident, or I can say like this. This is 5% probability or 95% level of confidence that my loss will not be more than 33. Okay, so we can say that higher the confidence, higher the expected loss. Higher the confidence and higher the, or we can say that lower the probability and higher the probability we consider, higher will be the expected loss value will be at the risk. Okay, so this was now it was in the this question we have said that if in the there is an area under normal curve table has been provided to you. Okay, I'm just showing by maybe visible. Okay, this table has been also given to you. Now, what is the purpose of this table? Sometimes student asks, sir, what is the purpose of this table? Now, if you see the table, just come to the value. In the table, you locate the value on the upper column on the first row. Let us see the, or we do one thing in the first column. We come to the value of 2.3. Okay, and correspondingly we look another value 0.03 from the first row. So correspondingly value comes 0.990. This value is there. Okay, so basically this is area under normal curve. Area under normal curve, that we can say explain like this. This is cumulative area. Here this value is 0.01, and this all value is 0.99. Okay, accordingly this value cumulative area is basically factor is Z score is 2.33. Okay, because it covers from this side is this side as well. So this is called area under normal cumulative area. It is called cumulative area. Okay, then there are one tail area and two tail area. See, when we talk about one tail area, that will be more discussion will take place in also in the class of derivative. One tail area, when we talk about in a one tail area, basically the value will be given like this. So then value will be only 0.01. Okay, so this value will be for the variate of 2.33. So these values are normally used cumulative area, and we detect it from the 1. Okay, whatever is the cumulative area, we detect it from the 1. Okay, because it is we are likely to use in the next question. Okay, no problem, student. If you could not get it right now, you will understand when we will come to the next question. Now I am talking about it was in this question the time horizon was 1 day. Okay, now we have to change it to the 10 trading days. Okay, so now student, please remember this is one thing customize. Okay, I have estimated my 1 day trading loss. Now I want to know what is my expected loss, or whatever my 99% confidence I say that my loss will be expected loss in the say 10 days. So the procedure is very simple. The procedure is very simple that we need not to go too much far. And for this, what we do, the expected maximum loss for 10 trading days shall be, just what we do, we multiply square root of 10 with a single day value. Okay, so here it will be rupees 147.636 lakh. So just remember one thing, we will not multiply with the direct 10, but will with the square root, because normally it is very important to note that at this student normally commits the mistake in here. It has been observed that they normally multiplied with the 10. This is wrong. We have to multiply it with the square root. Okay, please remember, we have to, whatever be the number of days, we have to multiply with the same. Okay, so please note that in the examination, okay, I just give you another example. In the examination, here you have been asked to give the given the value 1 day. Please remember, in the examination, it can value be given for the 10 day. Okay, then you have to think. Okay, then you have to think. And if they ask for the 1 day, okay, so you first compute the value of, say, loss for the 10 days. Okay, I just do it otherwise. Say, if I in the examination, the value has been given this like this. The exam in the examination, the value will be given like this. For the trading day, 10 trading days, 2% per day. For the standard deviation, will remain the same, no problem. Your in the question they can be say like this: if the 10 days, the value maximum loss of the portfolio can be 147.36 lakh. You have to determine the 1 day value. So just you need to divide it by 10. Okay, we shall do some MCQ on the same, then it will clear to you. Don't worry, we have a lot many more material on the same. Okay, student. Now I am coming to the next question. Question number 2. Okay, let us read the question. ABC Limited is considering a project X which is normally distributed and has mean return of 2 crore with a standard deviation of 1.6 crore. Standard deviation, always standard deviation. You will be used in a where. In a case ABC loses on any project more than 1 crore, there will be a financial difficulties. Determine the probability that company will be in the financial difficulty. It means we can say that company, they want to know when there will be a loss, when there will be a loss on the capital project. So as I told you, it can be used for the investment. When we were discussing about the uses of application of where there was one investment, then there is another capital investment project. So this is a version of the same. Okay, now I'm just presenting it by way of diagram. Okay, it says it has a mean return of rupees 2 crore. Okay, so we can say that this value is mean and this is rupees 2 crore. Okay, with the standard deviation, of course, this is a volatility. This is return is likely to be 1.6 crore this way or that way. Okay, and they want to say if the company's loss, very important, losses, okay, is more than 1 crore. Okay, so it means I can say that this value will be somewhere around this year. My minus 1 crore. This will be the loss. Okay, so determine the probability that company will be in the financial difficulty. So what I need to compute? I need to compute this probability. Okay, I need to compute this probability. Now, how I will compute this probability? I will use the concept of where, and from where what I will do, I will compute the z variable. Okay, and from z variable I will locate this value in my normal area curve, and then I will find the probability. Now, student, if you have got confused with the normal curve table, now here I will make you understand properly how we will use this normal area curve. And we can say that for calculating probability of financial difficulty, we shall calculate the area under normal curve corresponding to the Z score obtained from following equation. That is very important. How many? I'm just writing in a different ink. That is how many standard deviation it is away from mean value. Of financial difficulty. True. So now what we see, we use the equation z equal to x minus this and standard deviation. So here we have value is our minus 1 crore. So I put here value minus 1 crore minus 2, and standard deviation is 1.6. Okay, the variate comes minus 1.8750. 1.875. Okay, so we can say we will, or we can say, or we can, no problem, we use it either minus or plus. Now see, when we see the Z score table, I'm just coming to the Z score table. Okay, so this value will be there. First of all, my value is 1.875. Okay, this value will be lie somewhere. Okay, this value will be lie somewhere between 8.7 and 1.88. Somewhere it will be lie between it, because at the maximum I can value this fetch this value from this table. So what I do, I go this value, take this value 1.8, and correspondingly from the above of the table, I locate this value, and this value comes this. Okay, this is 1 point. This value is for the 1.87, and this value for the another value is 1.88. Okay, for this variable. Okay, so now I have to find out See, this value is with me. These two values are with me. I need this value. So I have to make adjustment of, say, 1.87, 0.005. I need this value. Okay, because I have to make adjustment of this value. I select this it, or I can say that 1.880 minus 1.875. Again, I can say, so I need adjustment for this value. I need to compute this value 0.00. So we will use interpolation method here. We will use interpolation method here. How we can compute? So compound, let us go back to the solution. By using interpolation method, okay, we have these values 9693, 1.88. This value is 9699. Okay, we find out the difference. The values, the Z score difference is 0.01, is equivalent to 0.006. Okay, so now I can compute value of 0.0 Z score. So what? How can I say like this? If the 0.00006 is area under normal curve for a, or I can say, sorry, not, sorry, I just exited again. For Z score of 1, the area under normal curve is 0.0006. For the area, for one Z score, the corresponding area under normal curve would be this. Okay, accordingly, for this value, Z score, the area under normal curve will be okay. So by this, I can compute the area under normal curve for this 0.005 Z score. Okay, this value comes, area under normal comes this. Now, the value of 1.875 can be computed by two ways. Okay, if I take the value of 1.875, okay, that is 0.9693, I add up the same. Okay, I add it. Okay, now the value comes 0.9696. Okay, if I take the value 1.88, Okay, the value comes here 0.9699. In this case, what I do, I deduct this value 0.0003. Okay, so both way I can compute the value. In one case, I have to add, another case where I have to deduct. So this value comes 0.9696. Now see, as I told you, this is the area under cumulative area under normal curve. Okay, this is the area under normal curve. Okay, this is the area under normal curve. So what I can do, this is the area. Well, I can say that like here my value, or I can say that if I have drawn the diagram here, yes, I can draw. So see, I'm using the red color here. So this probably we can say that this is the area under normal curve is coming 0.9696. Okay. Now, if I have to find this area will be now, this area will be 1 minus 0.9696. Accordingly, this value comes 0.03. I think somewhere around, let me check, 1 minus 0.9696. So it is comes rupee. Okay, this value comes 0.304. Okay, so or say it is 3.04%. Okay, student. So we can say that the probability that company will be in loss, will be in financial difficulty is 3 point this. Okay, student. I hope it is clear to you all. One second, there is one chat. Samanathan is asked, sir, reason for the square root. Actually, I cannot comment on the same because the maybe wallet because okay, I just tell you, very good question. Very good question. I call it now. You have very good question is there. Now, Samanathan asking very smart question. Why it is square root? Okay. Now, student, please remember when we were taking standard deviation, when we talk about standard deviation, it is square root of the variance. Okay, it is a square root of a variance. Okay, now when it is a square root of the variance, so basically variance is a prime measure. Variance is a prime measure of volatility. Okay, so accordingly, if we have been given variance, then we shall multiply with the 10. Okay, and then we shall square it. Square root, we will take the square root of both. So now Samanathan has suggested me very good question. Now I can this question can be say, if I say my standard deviation is say variance is 4%. Okay, my variance is a 4%. Okay, so my here my variance will be will be 4%. Okay, now my variance when be 4%, my correspondingly variance, or we can say, will be 40 lakh. Okay, now if I calculate 40 lakh multiply with this here, 40 lakh. Okay, and my what, or I can say my or I can, what I can do. Let me check. So my per day 40 lakh into 10. Okay, so 46 into, I just do like this, 46 lakh 460. Okay, 460. Then I have to take standard deviation of the same. 460 into square root and into 2.33. One second, I will okay, my value is 2.3. One second, let me compute here. I am just missing. Okay, see, 2.33 will be multiplied with the standard deviation. Please remember. Okay, it will be multiplied with the standard deviation. So it will not be square root in any case. Okay, so what I do, here I have taken 460, just you multiply it with, or my loss is say, one second, I'm just committing one mistake here. Not it is my loss is not 460, my loss is here is 40 lakhs. Sorry, my mistake. Now what I do, 40 lakh into this, so this become 400. Okay, then I become 400. I take the square root of 400. Okay, it takes the 20. Square root of the 400 is 20, and 20 is multiplied by 233. Now this value comes. Okay, so Samanathan, I think it is now clear to you why we use the square root. Okay, good question.
Yes, sir. It's clear now, sir. Thank you.
Okay. Okay, now students, so I hope this question is clear to you. Okay, so now I'm coming to the question number 3. Okay, and now I'm coming to the question number 3. Just read the question. This question has been adapted from the May November 2020 old scheme examination. Okay, just take a minute and read this question. The question says like that: on Tuesday morning, before opening of the capital market, an investor, while going through his bank statement, observed that an amount of rupees 7 lakh is lying in his bank account. This amount is available for use from Tuesday till Friday. Okay. The bank requires a minimum balance of rupees 1,000 at all times. The investor desires to take maximum possible exposure in the market, where the value at risk should not exceed the balance lying in his bank account. So we can say that somewhere it has put a cap. Here your maximum loss or possible loss that you can bear is rupees 7 lakh minus 1,000. So it becomes 6 lakh 99,000. The standard deviation of the index of the same market is 1.5%. Okay, this is a standard deviation per day. Again, very important. The required confidence level is 99% confidence. You are required to determine the possible exposure investor can take in the market. Okay, now see, it is a Tuesday morning. Okay, and you are like this is so you have a time from Tuesday to Friday. Okay, you have the time from Tuesday to Friday. Okay, when I say Tuesday to Friday, the period of investment I can say Tuesday, Wednesday, Thursday, and Friday. So Tuesday morning is there. So Tuesday, Wednesday, Thursday, and Friday. So these 4 days are available with me for making the, or I can take the position. I can say that it is a kind of a taking of the position. So what I do, I can take that position. For this position, what I do, I have to calculate. Okay, or I can say that it is somewhat kind of a reverse calculation. Okay, we shall see it. We can see it is some kind of a reverse calculation where we don't have the value of portfolio. Okay, from the maximum loss that we can earlier in the previous questions, like if I talk about this question where the value was say in these previous questions, uh, mean return was there, and in this, especially in this question, if I talk about first question, okay, so here my portfolio value has been given to me, but here I have to find out my portfolio value or exposure value. Basically, it is called exposure value. Okay, so it is very important. It is a kind of somewhat reverse process of calculation. Okay, now let's start somewhat calculation. Okay, so okay. Okay, so this was my available amount in my bank account, and this minimum amount is this amount available. See, student, generally when we talk about exposure, this exposure can be in the derivative market as well, because for derivative market, we does not have to make the full investment there. Only just we have to make some payment. Okay, so this exposure can be considered in that sense only. Okay, because amount available that for the loss is available for 699. Okay, or I can say that maximum loss for the 4 days at 99% confidence level.
Sir, which means the margin money what we pay.
Yes, it can be considered that way.
Okay.
Because if I say the investment, of course, this question has come in the form of investment. But now this, I am just changing this question. That's why adopted what I have used here. That's why. Because not only is a margin money based, because you have the amount this much is available. Okay, you cannot make the investment more than it. Okay, if it is sometime it is also considered like that. If I'm investing this much of amount or that way, but my maximum loss I can bear is this 699. So exposure can be taken different ways. Okay. So my maximum loss is here 699 again. Now I compute, I go by reverse calculation. My maximum loss for 1 day at say 99, same 90.9% confidence level. Okay, so this I can compute by 699 divided by number of days. As previously in an earlier question where the 1 day position was there, I have multiplied with the square root. Okay, we have gone with the square root of 10 days. Now here I will go by the reverse calculation. Okay, so it comes okay. It is clear to you.
Yes, sir. Here we have to use the 4 days, number of days.
It has been given to us. So we will go by
Okay.
reverse position. Okay, we are going in reverse calculation. We can say that. Now my Z score is 233.33.
Sir, here the set code is not given, sir. Whether we
No,
need to.
I told you, na, you have to keep it remain in mind. And I was just in the beginning, I was discuss. See, very simple. 99 2.33, 95 1.65, and that are normally used maximum cases. Okay,
Okay, sir.
if you keep in mind 95, the double of it, somewhat is the 2.33. Okay, only one figure you have to remember. Okay,
Yes, sir.
okay. Now we compute this volatility or standard deviation in terms of rupees. Okay, so the maximum loss divided by Z score at 99% level. Okay. Now I have, by this value, I have got the standard deviation. I have got this as a standard deviation. Now what I do? Maximum possible exposure in rupees. So what I do, I volatility in rupees divided by standard deviation, and my standard deviation value has been given to me. This value is here 1.5%. Okay, so what I do, sorry. So the resultant value will be here 1 crore. Okay, student. So we can say that with this we have come to the assignment end of the assignment number 2 of the chapter number 2. So now this was all about the wire. Yes.
Sir, in this case, based on the laws, we are identifying what is the maximum possible investment. But the earlier case,
for possible investment, you need the money. Okay. Exposure means, of course, sometimes I can say that you have told that this is a kind of a margin money. Okay, I can take this position.
Yeah. Okay.
Okay, because this much of amount is available with us. Of course, when this question has come, the word investment has been used, but investment can be considered in the exposure sense.
Okay,
because
sir.
you have this much of amount, then how can you invest 1 crore? The question will come now.
Right, sir. So, why I'm asking is how to interpret the question, in which way we have to work.
No, is there any other way around? If you tell me, I can discuss with you, no problem. Is another way of interpretation is coming to your mind? I can discuss, no problem, because it is a student's mind. There can be a multiple interpretation. So that's why I am free for discussing any other interpretation if possible. No problem. I am free to discuss. No, not an issue.
Sir, I would just like to ask, it's like when we say maximum possible exposure is 1 crore, is that like out of our 6,99,000 investment, 1 crore is the maximum amount we can earn, or
play in the derivative market?
In the derivative, is that what we can earn with 7 lakhs? Yeah.
It isn't not with the.
It's like, is that the maximum amount we can able to earn?
I can lose.
With that
I can lose. I can lose this amount maximum.
Like we have 6,99,000 in our account, so that could be the maximum amount we can lose.
We can lose. Yes.
Is that like?
Is that like the maximum amount? But
because
how much I can take the exposure? Please tell me.
It's like we only have 6,99,000 in our account. And when we say the maximum exposure is 1 crore, so it's like when we only have 6,99,000, how could our maximum exposure is 1 crore? It should be like the maximum.
That's now problem. See, actually, when we will discuss the topic of derivative, then you will come to know, because in the derivative, with a small amount, we can take the huge positions.
Correct. So it's like with that 6,99,000, we can get up to 1 crore, and we can also lose everything.
I can do the trading of the 1 crore. I can do like this.
Okay, okay. So we can gain until 1 crore and we can also lose completely.
Not generally, not in derivative market, this much of not 1 crore. I have make some exposure. So this gain can be, of course, 1 crore can be possible, but rarely it happens. Generally, this somewhere around 10 to 20%.
Okay.
Yeah.
Okay.
Yes, sir. Yeah. That is the advantage of the derivative market.
But see, there is other side as well. You will lose the whole amount.
Yes, sir.
But see what happens. That's why whenever we start the class, always say these are only for academic purpose. Don't indulge yourself in derivative trading. This is my request. Okay. Okay, because it really it comes into our mind. Oh, we can make the money. Okay, sir. Thank you.
Yes, sir.
Okay, now so student, I'm coming to the other part, that is remaining part of the topic. Okay, after that we will take some MCQs and even I will take one case scenario. So before going for the break, I think we can do one thing. If I check it out. Okay, I do one thing. I first of all I take the assignment, or I can do one thing. I just take the remaining part of the okay. We can do one thing, student. We just take the cover the risk quickly. Remaining part of our study material. Then I will take to the assignment in the second part. Okay, so now we are coming to this slide. Now we come to this appropriate method for identification and management of financial risk. So we can say that sometime it has been seen that by why we normally face the counterparty risk. What are the, we can say that we can say that some of the reasons, or the we can say illustration, like we have failure to obtain necessary resources to complete the project or transactions undertaken. Okay, see what happens. Counterparty risk sometimes it is just like, say, I give you one good example. It normally happens now since RERA is there, but earlier, say around 10 years back, some builders have come into NCR since I based in NCR Delhi. So in NCR Delhi, in Noida and somewhere in Gurgaon, more happened in Noida. Some builders have come. Okay, they have launched a project. Okay, so what they have done, they have estimated some cost. In this cost, we will complete the project, but due to some reasons like inflation, etc., but they could not complete the project, and ultimately they ran away. So by this, what happened? The money of the investor who have purchased in the pre-launch, or their money got stuck up. Of course, by later on, NBCC has come in, government in the form of, through the route of NBCC has came into the picture, and they have start completing the project and handing over the possession to the flat owners. So this kind of situation, sometimes a project cannot be completed. Okay. The other case can be any regulatory restriction from the government. Sometime a business may fail. Okay, so any government restriction has been put, as other party could not be complete the project, or they could not say complete this project. So this is okay. What I can do? My government has put a restriction on the same. Then hostile action by the of the foreign government. Yeah, that I told you in last class. Like Venezuelan oil crisis are there. So ultimately, money is stuck up there. The and even there is one very good case in this regard, that of course it is also called settlement risk. I'm just sharing with you. There is one very famous case. If you check website, Erste Bank case. Okay, Erste Bank case. In this case, what happened? I think it was somewhere around in World War. So exactly, I could not recall it the place, but I am just telling you what happened on a broadly. there was one bank in Germany, another bank was, I think, in London. So due to restriction with the due to war with the Germany, the transactions between the banks was disallowed. So due to this, what happened? The money that is likely to come in exchange of someone has bought the foreign exchange, they have made the payment. Okay, they have made the payment. I just give you by way of example. Suppose there is a bank A in country A, and there is another bank B in country B. Now what happens? Bank A, say the country are mutually exchange the currencies. Okay, banks generate. Now say the currency of this bank A is A, and this currency of I can say that this currency of bank B is B. Okay. Now see what happens. This bank A needs the currency of bank B. Okay, or the country B. Okay. Now what happens? Yeah, I do like this as X or Y. I just presume it that way, then it will not confusion. Now this bank A needs currency Y. Okay, so what they do? Bank says, okay, you make me the payment in currency X. Okay, now bank A make the payment to bank B of equivalent amount in currency X. Okay, while Y was going to transfer the money to bank A, so the war broke out. Okay, the war broke out. Now the transaction between these two banks is prohibited. So what happened? This bank A has completed its part, but bank B could not complete its part. So in this case, the bank A is exposed to risk, counterparty risk, we can say. Of course, it is a kind of a settlement risk, but it is to some broadly, it is, we can on a macro basis, we can say that it is a counterparty risk. Now, because war is breakout, bank B says, I cannot make you the payment. So this is one of the examples some happened in case this. Then let down by the third party. The third party we can say that at his own can say I will not make payment. Okay, willingly. Okay, or willful defaulter. We can say that. Okay, or the counterparty has become insolvent. Okay, and if you remember that, it is a very interesting. Generally, whenever we talk about our accountancy, commerce, the insolvency word is very prominent. Okay, because when when we was entered into 11th class, 12th class, of course, insolvency word was there, but the concept of more insolvency we have come to know when there was a very famous rule, Garner versus Murray rule. We have referred it in our accounting. Then we came to know what exactly happens in insolvency. So from if they have become the insolvent, of course, the money is stuck there. So all these are, we can say that appropriate, we can identification and management of. So first of all, we have to see what are the basic types of a, we can say that what are the indication. Okay, what are the indication or due to what reasons? We can say that what reasons our insolvency counterparty risk takes place. Now, what are the various techniques? It is very important. Of course, see, we cannot avoid this risk because it is a part of business. Okay, it is the part of business. So how we have to conscious ourselves? First of all, we have to carry out due diligence before with any we're dealing with any third party. Then never commit to the single party or the connected entities. That is also in the last class I told you, concentration risk. Okay, that is called concentration risk. Know your exposure limit that we have used in the WAR. Okay, this exposure limit is basically WAR, linked to the WAR. That I know this much of more than this amount, I cannot take the risk. And that is normally used in case of treasury as well. Okay, where we are making the investment in companies. Okay, there we have to put some benchmark, where we have to put a WAR. Okay, so this is relating to the WAR. Okay, review the limits and the procedure credit approval regularly. These limits we have to check whether it is crossing where or not. Okay, and we have to see the procedure. What are the procedure? Are they going crossing this limit? Because sometimes due to some changes in the procedure or some changes in the market, our old procedure becomes outdated. Our old procedure become the outdated. So this has to be kept in mind, because with the dynamism we have to see the we cannot because see, I will tell you very frankly or not. I tell you one very good example. Now earlier there was earlier there was used to be video cassette, etc. Okay, so generally video cassettes are not used to be copied very quickly. Okay, so generally that's why the companies were not that much worried. But with the advent of the IT information technology, now with a one copy, master copy, you can create thousands of CDs. Now CDs are outdated. Now you can transfer it by any mode. So this now companies has come out with a restriction of more stringent rules for IPR. Okay, you cannot copy the same. So these are all things that we have to take care. So generally we have to say that if the rules are changing, then we have to accordingly make our dynamic to be changed. Rapid action in case of event likelihood of any event. If any indication is there, so it is very important that you recover back your money at the earliest. Okay, you recover bad, and it normally practical happens. I just on a very fun humor side. Say if anyone of your friend, you have given some money to him. Okay, so if he is a rich people going on well, you may not ask for your money back. Okay, he will pay someday, other day, that you may consider. But once you have any indication that he is likely to be going into some financial problem, then you will start asking for your money. That is just on a lighter side. So that's the case. You just quickly make then use the performance guarantee, insurance, and other instruments. Generally, these are used as a hedging instruments. Of course, hedging instruments are generally used for the foreign exchange, etc. But in this case, you can take some insurance or you take some performance guarantee. Generally, these are kind of a performance guarantee letter of credit. This letter of credit is basically kind of a guarantee that is given by the bank of the importer. Okay, that in case if it does not pay the money, I will make you the money. So this kind of a form of guarantee we can take. So these are all basic theories portion that how we can manage the risk. Of course, just we have to understand, because risk is inherent in any business and we cannot avoid in any case. So now next comes is a political risk. This risk, I can say that generally this is relating to the government actions. Okay, and especially this is relating to the host country. Even political risk exists in our own country. Sometimes due to some change in the government may not be that friendly with some particular industrial houses. So in that case, of course, they can face a backlash, but generally in case it is more prominent in case of a foreign investment. Like sometimes it insistence on the what are the say we can say that what are the actions that which we can from the following action of the government. Like they say that you employee you cannot make your own investment. Our investor will make investment in your business. Even you have to take our own labor. Restriction on the conversion of currency. It is very common. I remember that in it is practically happened. Generally, sometimes it happen. It is sometimes the money could not be reverted back. Okay, just I give you an example. Now, if a company of USA has invested in India, okay, say after say 2 or 3 years, they will start. They will likely to take the money back to their own country. So when they will need to take back the money to their country, the money cannot be transferred in the rupee, because this in the USA rupee is not used. So what they want, they say, I want to convert this rupees into US dollar. Now government put the restriction. You cannot convert this amount into US dollar. Then what will happen? The profit will be there. Okay, you cannot bring out the money. So this is one of the indication. Expropriation that I have discussed with you, Venezuela case. Okay, price fixation of the product. It is sometime what the government says, okay, you cannot charge the price more than this. So these kind of restrictions or actions of the government are there, that these now it is a basically we can say that it is a beginning, or it is a kind of a beginning, and we have to be very conscious. If these some indicators are there, then we have to take the some measures to combat this. Is okay, students. So with this, we are going for a small break. Okay, after the break, we shall continue our discussion. Ashok ji. Ashok ji. Okay, student. And we are taking a break. Break, sir. we have discussed this much points. Now we are coming to the next slide. Now, what are the various measures that can be taken to so that we could assess the country risk? Okay, we get country risk. Okay, so what are these risks are there? These are by referring the political ranking. It is one of the very important. There are some magazines that publish the risk ranking of the countries. So these magazines we should refer. Okay, by taking advices from the embassies of the home country in the host country. Now, generally, embassy is like India have an embassy in Africa. Okay, now this services of these embassies can be used to assess the political situation there. Then by evaluating countries' macroeconomic condition, it is one of the very important because it is also linked to when we talk about the topic of EIC analysis. Okay, when we shall discuss the topic of security analysis. Okay, this is one of the very important element there because EIC analysis means economic. I'll just tell you here. Security analysis topic. Normally we carry out the EIC analysis. E means economy. Then I means industry. And C means company. Okay, so normally we carry out this analysis. One second. So it is one of the first step in making some investment. Okay, so that's why we say that economy analysis, we in this generally we refer the macroeconomic factors very important. Okay, and these macroeconomic factors are we can say analyzed before making any investment. Then by analyzing the popularity of current government and assess their stability, it is one of the very important factor. We have to see whether the current government, the popularity is there or not. If it is likely to be less popular, then it means there is some political problem is likely to take place. So we have to avoid this kind of a risk. Now, following techniques can be used to mitigate the risk, political risk. Thus, this can be avoided by using the local sourcing of raw material and labors. See, what happens when the local peoples are employed? So it means generally government does not normally avoids to expropriate the business because normally what happens, they say okay, the people are getting the jobs and ultimately it is leading to the growth of the economy. Because see, once the government will trouble them, they may move out. Okay, then when they move out, then there will be a crisis of the jobs as well. And even some raw material supplier will be there, they will also in problem. So overall, the development of the country can also make this in structure the business in such a manner that the country's development is also dependent on the particular business. And entering into the joint venture, it is one of the very good manner. You take some local vendor there, okay, enter into the joint venture instead of establishing a new business at your own. So involve the, like here we can say that Maruti Suzuki. Okay, Maruti Suzuki is the best example. Suzuki company has ventured with the Indian company. Okay, so Maruti Suzuki is a kind of a joint venture where they went into for car manufacturing. It is one of the example. Then local financing. But it is a very good method. Okay, instead of borrowing the investing our own money, you borrow or you take the money from the host country's investor itself. Because if the host country's investors' money will be there, then the risk of expropriation becomes lesser and lesser. Because the government will be think that, or otherwise investor will make a hue and cry. Then is prior negotiation. Generally, it is also very used. It is a prior negotiation is used in the case of a government. It is entered that in case if their action will be taken, government expropriate, then government will compensate them. So all these agreement are entered with the government, so that in future in case any problem comes, then they get the compensation for the same. And even sometimes they also use the insurance. Okay, they can also use the insurance. One is one of sometimes even insurance companies provide the expropriation risk coverage as well. Okay, then next point comes the interest rate risk. Okay, how we identify the interest rate? It is basically the monetary policy of the government. Now see, government monetary policy generally say RBI will come out with the RBI. It is one of the very important, like in India, when RBI comes out with their monetary policy rate, and these are generally rate are relating to repo rate, etc. Because on the based of repo rate rates, the other rates are dependent. Okay, especially in case of a floating rate. Generally, as I told you, in case of any lending and borrowing, what the benchmark rate is repo rate. Okay, in plus and minus, generally in plus, we make some basis point addition. Okay, what we do, we make some basis point addition. One second. Okay, we made some basis point addition, but this benchmark rates impact a lot of this interest rate risk. Okay, just like give you a small example. Suppose you have lent the money to the bank A. Okay, rupee 1 crore. Okay, the rate fixes as say I can say the PLR or prime lending rate is also there. Prime lending rate plus 1%, or we can say that repo rate something 1%, that is 100 basis point. Okay, now this rate has been, say you have put in, you have deposited the money with the bank, okay, for a 1 crore rupee, and this is the rate is now post today's repo rate is 6%. Okay, so accordingly you will get the rate of interest of 7%. You show that. Now tomorrow RBI as per their monetary policy reduce this repo rate to 5%. So of course your investment or your deposit will carry the you'll get the interest at the 6% per annum. So this is kind of a risk, and this is generally depend on the monetary policy of the government. Any action taken by government such as demonetization, it is one of the prime example in the 2016 when the demonetization taken place. So generally the bank rate of interest start volatile in a very huge manner because of there was a pumping of the money in the market. Bank has a huge deposit. At that time, what happened? Bank has a very huge deposit for for lending because too much deposit was there with the bank. And then economic growth is also a very matter because with the economic growth, rate of interest are likely to rise. Okay, more and more business needs the money and ultimately lead to the higher rate of interest. Release of industrial data. Good data is a kind of a where the interest rate goes up. Okay, it may indicates a positive sign because new investor starts entering into the market. Even from the foreign country, the people start investing the money in India. So this the money, the demand for the Indian money becomes higher, and with this interest rate comes invested by foreign investors that I told you. Then stock market changes. It also very impact a lot. Of course, it is a matter of debate whether is there any linkage between the stock market and interest rates. But generally, it is seen that when the stock market crashes, okay, more and more people moves to the fixed income securities. Okay, and with the more demand, the rate of interest are also likely to rise. Okay, because war between the countries, of course, it is one of the reason. Yes, Samanathan. It can also be because generally when the war of the country, interest rate also impacted. Generally, government at that time the government sometimes needs the funds. Okay, they can increase the rate of interest. So there can be n number of reasons, but these are some illustrative. See, in a practical sense, if we see that there are some these are some illustrations. But whatever reasons you give, you need to explain the same. Now next comes a counterpart. This is currency risk. Okay, some are the parameters to identify this currency risk. So first of all, the government action of any country has a visual impact on its currency. For example, UK government decision diverse from the euro brought the pound to its lowest since 1980s. That I have given an example in my earlier class also, that Brexit, like government actions, sometimes indicate that there is a currency risk. Okay, and due to this reason, suppose if any Indian investor have a huge investment in UK, of course they is likely to suffer because the pound has become weaker. Then nominal interest rate parity, the currency exchange rate depends on the nominal interest rate. I will not discuss here because it will take another half an hour. Okay, but just to remember that this interest rate parity theory is covered in the interest rate, this is foreign exchange exposure chapter, because there are basically two theories are there. Purchasing power parity, rather we can say three theories are there: interest rate parity, purchasing power parity, and Fisher theory. So basically, two theories are mainly covered: interest rate parity and purchasing power parity. So here, what is nominal interest rate? I just tell you one briefly. I am just touching upon here is, tell me what happens. Just for your time being, we can say that I'm just discussing the formula here. Basically, in a nominal interest rate, we incorporate the inflation. Please remember. Okay, so we can say that nominal interest rate is equal to once again 1 plus real rate of interest into 1 plus inflation rate in the country. Okay, minus 1. Okay, so what happens? Generally, this real rate of interest remains the same. Okay, this inflation keeps on vary from country to country. Generally, this almost are same or somewhere 1 or 2% maybe difference there. But this inflation rate differs a lot from country to country. So due to this nominal rate, the country with higher nominal interest rate, their currency is likely to be devalued. Okay, because inflation is higher on that side. Okay, this topic will be more discussed in detail when the topic of foreign exchange will be there discussed. So please keep it right now. Once you will understood this topic, then you will not face any problem in memorizing the same. Then inflation rate, purchasing power parity theory impacts the value of money, as I told you, because as per purchasing power parity, interest rate higher the purchasing interest rate, so lower the because purchasing power parity means generally inflation rate impacts the higher inflation rate, lower the value of the currency. I'll just give you a small example, then it will be clear to you. Suppose I'll just very yes. Now suppose 1 kg of apple price say $2 in USA. Okay, and same are costing say around 190 or I can say 180 rupees per kg in India. Okay, now see what happens from this parity, purchasing power parity. I can say $1 will be equal to rupees 90 per dollar. This rate can I say this will be my equilibrium rate. Okay, now suppose inflation in India is say 7%, and USA it is say within the same year, 1 year, say after 1 year. Okay, yeah, during the year the inflation is 7% and USA it is 2%. Now what happens if I have to, after 1 year, I buy this same apple? Okay, it will cost 1.02 in USA, and same apple will cost in India to me 180 into 1.07. Okay, so this much of same Apple, the US after 1 year I will pay this much of amount, and same Apple in India I will pay this much amount. So according to this, my new rate per US dollar will be, sorry, my mistake here, it is considered 2.04. Sorry. Okay, I just forgot. I just consider here it is a $2. No? So my inflation is here 2%. So this is the same for same Apple. I will need to pay $2.04 in USA, and for the same apples I need to pay 192.60 in India. Okay. Accordingly, now my value comes 192.60 divided by this. Okay. So my new rate becomes 94 rupees per US, for 41 paisa per US dollar. So this is an indicator that if the inflation is higher, that there is a higher currency risk. Okay. Now next is natural calamity. Any natural calamity can have a COVID impacted import and export lead to currency risk on natural calamities. Yes, you are right. It was a very even I will say it is a after it is a natural calamity. We can say that, or even sometime what happens nowadays, even climate risk is becoming one of the important risks. Seeing like situation in some countries, like there are flood and there are earthquakes, are their currencies rate impact one time. Of course, they becomes normal after some time, but at one time this rate can be impacted. War, coup, and rebellion, etc. Okay, instability brings the currency's value down. No, investors start pulling out their money, change in the government. Okay, um, change in the government and its attitude towards foreign investors helps to identify the currency risk. Any government who means better, it is the you can say it is a rebellion by they become the rebel. The police become the rebel. Okay, police take over the, or the army take over the government. Okay, they become the rebel, and they become the they abolish the government and they take over the control. Okay, army take over the control. It is kind of a coup. Okay, generally it happens in recent. There was some case like Myanmar, etc. In 2021, I think there was a coup. Okay, students. So this was our this portion. Now we are coming to the next part. Okay, so student, with this we have come to the topic of the end of the risk management theoretical part. Now we are taking some MCQs as well as some one case scenario. Okay, so let us go to the case MCQs. Now, student, these are some MCQs, and of course, I want you should post your answers. Okay, you post your answers, and please remember, study material, use of study material is very necessary. So I will request you to read these MCQs, and I'm giving you the time of 1 minute. Okay, you start answering the same so that we can proceed further. Yes. Samanathan, your answer is correct. So the option is strategic risk. Yes, Chitra, your answer is correct, beta. Very good. Okay, so the correct answer is option D. Second, the okay, just hold on. I just give me some time, but other students are also trying. Now, students, this is a question that we have discussed in the class. Just try at your own. Basically, it is one of the using the factor. Yes, right, very right. Also, it means you have well understood the concept. Okay, it means you have very well understood the concept. How we have computed it? Yes.
It's a 10 is a square root of that and
Yes,
multiplied by
yes,
100.
yes. Very good, very good. Very simple. Okay, now we are coming to this. You have to assume this much of dates and days in a year or in a week. So here our annual wear of a portfolio is this. The daily wear of the same portfolio shall be approximately. Yes, Chitra, you are right, beta. No, it's the let me check. No, no, beta. Yeah, okay, yes, very good, very good. Samanathan, yes, you are also correct. Okay, now let us see how we can solve it. Simple it is. It is a wear of the portfolio is 96,424, and this is annual base. Okay, so to make it for a 1 day, as we have in previous, we have multiplied it. Here we shall divide it by square root of 250, and the resultant figure will be okay. Similarly, we come to the fourth MCQ. Yes, you're correct, beta. Chitra, you're correct. Okay, now the answer is option C. Okay, how we have computed it? Simply, we have computed by using, yes, Samanathan, your answer is correct, beta. Here now it is on a weekly basis. So we divide it by 50 square root of it. And now we are coming to the last MCQ. Yes, you're right, beta Chitra. And I will say, student, please remember one thing. Nowadays, in the paper of AFM, it is quite MCQs has become one of the very good. We can say that it is a very good source of scoring the good marks. Because now here, yes, you are Samanathan, you're correct. Here you have a choice. Now, if your answer is wrong, of course you will came to know that I am going on the wrong way. Okay, you can correct it and correct the correct option. So very good. The correct option is C, and it comes like this. Okay, so it will be okay. Is it clear to you? So now with this we have come to the end of the exercise of the MCQ. Now let us take one case scenario. Okay, that is case scenario available in your case scenario booklet, or you can also have it from your download it from the website as well. Okay. Now just read this case scenario. Student, I will give you one tip. Whenever you have a case scenario in the examination, you just give a one plain reading. Okay, don't try to match the answer in a one go. It will in the next time you will see what happens when you go understand what is case scenario is all about. Okay, in the second reading, just start linking one or two questions only. Okay, even if it is not matching, no problem. You give a third reading. So more and more reading you are giving, you are coming more and more near to your answers. Okay, now I'm just start reading the case scenario. It says that XYZ Limited is a medium-sized company in a renewable energy sector, is experiencing steady sales growth. The company's management, however, is concerned about balancing rapid growth and a long-term sustainability. Okay, when the word has come sustainability, it means one second. I think there was. Okay, when the question has come sustainability, so it means we have to. So here it is a hint that growth word is there and sustainability there is somewhere nearby. The past year's XYZ growth objective has led to aggressive expansion plans, but management now realize that such growth might not be financially sustainable in the long run. So we have to see that is whether it will be financially maintainable, sustainable or not. Okay. This raises concern about how to maintain companies' financial health while meeting its ambitious growth targets. Okay. CFO company of XYZ Limited highlights the importance of the sustainable growth rate, SGR. Now here we came to know this question is relating to this topic. The company needs to ensure that its operation and financial policies align with this growth sales. XYZ must avoid expanding too quickly, which could strain its financial resources, that is leverage effect, and lead to excessive borrowing, leverage effect. Because more growth will be there, of course, you will need more resources. Moreover, management must also consider that the long-term implication of resource consumption, particularly in renewable industry where the sustainability is key, both current and future stakeholders. Generally, this kind of projects are relating to the ESG. Okay, so they are generally here. They have to see that because we cannot ignore the environment factor by making a rapid growth. So we have to consider this factor as well. XYZ realized that it needs to focus on building its growth capability alongside its growth strategy. Without necessary infrastructure and financial planning in the place, the company's effort to achieve long-term sustainable growth could be zero priority. Furthermore, the company is aware of the risk of relying too much on the external financing. Okay, we have to limit our external financing and recognize the need for a balance between maintaining sufficient equity and minimizing debt. That is very important. Given the importance of these considerations, XYZ management team must now renew their growth strategy, financial policy to ensure that they consistent with the sustainable growth objective. From the following, from the information given above, choose the correct answer of the following. So first of all, if you have referred the study material, then first part you can answer. First question you can answer. If you have referred the study material after the class, I am waiting for your answer. 1 minute is with you. Yes, you are right, Samanathan. Yes, Chitra, you are right, beta. The correct answer is Robert again. Because once you will go through the syllabus, complete syllabus, you will come to know that this hero market which is related with the portfolio management chapter. Okay, this William Sharpe is also name is attached with the portfolio chapter. Black-Scholes name is attached with the derivatives. Okay, now we come to the next MCQ. The sustainable growth rate as here represents that there are four options. Option A, B, C, and D. Okay, now time is 1 minute with you. You just read the options and mark the correction very carefully. Mark the option very carefully. Yes, you are right. Chitra, you are right. Yes, Saminathan, you are right. Okay. The correct option is B. Okay, because you have to maintain, because you have to maximize the rate of gross sale, achieve that can be without additional funds, borrowing additional fund, more and more fund need to be borrowed. Okay, then we are coming to question number 3. Yes, you are correct. Correct, beta Chitra. Yes, option. Okay, so according to the case scenario, that is asset growing too quickly, is that company could face the liquidity issue over the due to this. Yes, Samanathan, you are correct. Yes. So we have to maintain our growth capability along with the growth strategy. We have to balance somewhere, make it between them. Okay, now we are coming to the last question. Yes. in an inflationary condition, if you are right, both of you, if creditor requires that XYZ limited historical cost of debt to stay constant, then inflation lowers the sustainable growth rate. One student has given A, reduce needs. No. Let me check who has given this option. Option B. Just now. Option B, I don't know. Someone has given option. No, beta. Chitra, this is not the answer. Is A, because reduce the need for external financing. Rather, it increase the need of external financing, because with the inflation we need more funds. So generally, what it does, it leads to sustainable lower the sustainable growth rate, because with inflation we have a lesser and lesser profit. Okay, and since we have maintained our debt equity ratio, okay, we are not borrowing additional money. Okay, we are not borrowing additional money and additional funding, and ultimately what is happening with inflation, our profit is going down, and ultimately it is impacting our growth rate. Okay, so it will lower our sustainable growth rate. Okay, yes. Okay, student. So with this, we have completed our topic of this risk management as well. Now, when we talk about the this, since we are on a complete this topic, so 1 second. If we go back in the previous 2 classes, what we have covered our discussion on the topic of financial policy. This is our topic on financial policy and corporate strategy. And we have also covered discussion on the risk management in the previous 2 classes. Now, from these 2 topics, you have seen that both topics are very important, and rather they form the basis of some of our forthcoming discussion. Now, these topics are important not only from our practical life as well, it is also used from the examination point of view. So any question, sometimes student ask me, sir, which topics are important? Can I skip this topic? So my advice to you, please never skip any topic. So in today's class, we have covered our topic of where. Okay, 1 second. I'm just going back to. Okay, in today's class, we have covered the topic of where in very detail, and what are the theoretical aspects of the other risk. So these were the 2 topics today we have discussed, and for the where we have come to know how we can move from because customized variables are like number of days, okay, and our basically number of days and our confidence level. These 2 things are variable customized, and accordingly we can vary. Other things are given to us, and we have to work with them. So these are the topic we have discussed covered in the where discussion. Then we have covered our theoretical remaining part of our risk management. So student, now with this, I'm coming to the end of this class. As I told you, our class will be now on the Monday and Wednesday only, AFM classes. So please note this point. As student, before I wind up, you know that this is my contact number, or you can send me an email at sfm-final. So you can send me email, or this you can contact this, or even you can also use the mobile app. Okay, mobile app, there is a ICAI, something like there, where you can post your query. It will be replied in 48 hours or 72 days. Sometimes it may take some time, more time, but generally we reply on the same, and even we reply in the mail. Ashok ji, I'll open the session for students. If any student has any query, they can free to ask me.
Sir, in this risk management, what is the expectation? Is it a theory question or the numerical question, sir?
I am not a paper setter. Okay, see, as I told you, it is the we can say freedom of the paper setter, how they want to assess you. So we cannot put any restriction on them that you don't ask theory, don't ask only ask numerical, or ask numerical, don't ask theory. So they have their own ways. And if you see that sometime a mixed question as type of question, this time in examination, there was very good question has come. It was a very good question. A person is entering into a foreign transactions with some say country China. So what are the risks they are faced? Normally, only one risk come into our mind and that is foreign exchange risk. But we have to widen our horizon. The other risk we have to consider as well. So because this question relates to the chapter number 2, most of the students have considered it to be related to the chapter number 10 only. So this is the thing. Okay, so anything can become, I cannot restrict it. Okay, of course, we can say that to some topic, numerical questions are generally not asked, but in a risk management question, because see, I have discussed with you 3 questions, practical, so anything can come.
Okay, sir.
Okay.
Got it.
Sir, I just want a quick suggestion from you. It's like, could you please guide us on the preparation strategy if you can? Like whatever we are discussing here and practicing them would be sufficient for the examination, or do we have to go through few
Okay.
other materials, something like that?
Your name, beta?
I'm Chandra.
Chandra. See, Chandra, actually, regarding the strategy, I tell you one thing. Of course, we have a separate sessions for the same viewers for the success. Where when you have to appear in your exam,
I'm planning for September 26th.
26 September 26. So still you have a lot of time. Of course, you will finish up your syllabus just now. I understand it. Okay, then see once you finish up your syllabus with the basic contents like study material. Okay, whatever the contents available on ICAI website. Okay, you refer all the questions from there. Okay, now see right now since you have started this paper, so mock test I will not refer. Once you finish off your syllabus, so I show you how you move further. Once you finish off your syllabus from the study material as per our discussion in the class, because normally what we have done, we have tried to cover as much as possible questions in our assignments. Okay, and then after that, then you start referring RTPs, revisionary test papers. Okay, and if possible, you try to attempt mock test paper. I will say even if you have to take the exam, say in September 26, but once you finish off your syllabus, mock test papers are available on the website. Even where you are staying, where because the branch nearby may not allow to you sit in the exam for the same exam, but you can try mock test at your own. Okay, and even you can and you can take guidance from the solution. And if you have any issue, you can contact us. No problem. We will guide you in this matter. And for more questions are to become, when you will start attempting mock test, at least I think there are how many attempts will be there? September 25, May, January 26, then May 26. At least you have a more sources. Okay, so do all the refer all the mock tests. Okay,
Sure.
then you will have a lot of material over there. And remember one thing, I suggest one thing to every student. Please remember, student, please try to develop your conceptual ability. Okay, once you understand the concept now, then any type of a question come into the exam, you can attempt it very well. Okay. Or if you need more clarification, you contact me over the telephone. I will throw the light. And if you have any doubt, you are free to discuss with me.
Sure, sir. Definitely.
Okay.
Thanks.
So, okay, student, with this, we come to the end of this session. Now, in the next class, we shall start with the new topic, that is capital budgeting with risk. Now, in this regard, my request to you all students, please remember your concept of capital budgeting should be very clear to you. Because if your concept of your capital budgeting is not clear to you, because it is the advanced version of the capital budgeting. The basics of the capital budgeting you have discussed at your intermediate level, and there are 3 techniques. One is your NPV, then it is your payback period, and then IRR. The more use of NPV will be in this topic. Yes. Okay. So more use will be in this topic on the NPV will be more used in this our class discussion, where we will see when we incorporate, and there are not only risk, even inflation. We will see how the inflation impact our capital budgeting decision. And in this examination, May 2026, there was one good, very good question, and I think it will be possible. I will shall get it incorporated in our assignment as well. Then there is a adjusted present value. Then there is a topic of replacement cycle. We have to see when it is prudent to replace any asset. So all this, so that's why it is broadly this topic is called advanced capital budgeting decisions, which include risk, okay, inflation, then replacement, and restricted plant business. So 4 topics are covered there. So student, see you in the next class. This class will be on the coming day. I think it will be on the coming Monday. Okay, so that's it, and see Jagbandhu sir Padi will take the class. Okay, of course I will be there in the class as well. Okay, student, thank you very much for the patience listening, and have a nice day. And again, I repeating once again, now class will be on Monday and Wednesday only for the AFM. Thank you.
Thank you so much, sir.
My pleasure. My pleasure.
Thank you, sir.
Thank you. Thank you. Okay, Ashok ji. Now, yes, over now. Okay.